Endowments and pension funds overseeing trillions of dollars don't pick stocks based on intuition or market headlines. They rely on rigorous mathematical frameworks that remain largely invisible to the everyday investor. This interface reveals that exact hidden landscape. Mindrative evaluates every possible combination of your chosen assets, mapping out the mathematically optimal portfolios that humans simply cannot calculate by hand. This methodology doesn't rely on a new experimental trading algorithm. It is built entirely on foundational economic theory that won the Nobel Prize. Harry Markowitz proved that for any given group of assets, there is a precisely definable combination that delivers the maximum possible return for a specific level of risk. Retail investors often make the mistake of hunting exclusively for high returns, completely ignoring the accompanying risk. They optimize for only one axis. To truly optimize a portfolio, you have to stop looking at individual winning stocks in isolation. You must map out every potential combination to explicitly identify and eliminate the suboptimal choices. Institutional portfolio theory is often buried in intimidating jargon. Before we look at the data, we need to translate the 3 core metrics you will use to evaluate your assets. Think of this like driving a car. Expected return is simply your speed, how fast your money is actually growing year over year. Volatility represents the physical roughness of the road. It measures the bumps, drawdowns, and unpredictability you experience along the way. This text breaks down the Sharpe ratio, which is your ultimate score. It balances both concepts by asking a very practical question. Given how rough the road is, are you traveling fast enough to make the trip worth it? The platform's engine takes your selected assets and runs over 3,000 Monte Carlo simulations. It tests thousands of combinations, plotting the exact speed-to-bumpiness ratio for each one. Mapping an entire risk-return landscape at this scale requires immense computational power, but the process takes only seconds to execute. By understanding the Sharpe ratio, your subjective feelings about risk tolerance become a hard mathematical target that the software can automatically hunt down. Let's look at exactly how you initiate this simulation within the platform. This screen gives you 2 distinct entry points. You can load a pre-curated basket for an immediate analysis using the green button, or use the portfolio constructor to handpick your own custom symbols. This chart shows the immediate result of the analysis. A massive cloud of simulated portfolios forms a distinct upper boundary, known as the efficient frontier. Your primary target on this curve is the green dot labeled Max Sharpe. This point represents the absolute best risk-adjusted return available for your specific list of assets. The secondary target is the yellow min variance point on the far left edge. This configuration is focused purely on capital preservation, offering the lowest attainable risk. The reality revealed by this chart is clear. Any portfolio dot sitting below that solid frontier line is mathematically inferior. If you choose one of those, you're leaving money on the table for the exact same amount of risk. The underlying mechanism that makes this risk reduction possible on the efficient frontier is the mathematical correlation between your chosen assets. If your portfolio has high correlation, your assets are near duplicates in terms of market behavior. During a broad market drawdown, they will inevitably crash together. Negative correlation, where assets move independently or in opposite directions, provides a structural defense. Finding these specific pairings is the only true free lunch in finance. This correlation matrix verifies safety by cross-referencing every asset ticker in your basket. Look for an abundance of green and dark boxes. These indicate negative correlation, confirming your selected assets will protect each other. This text block outlines the final step in the sequence. Once you have a perfectly balanced, stress-tested allocation, you can export the exact weightings for execution at your broker. What used to be a highly complex, institution-only quantitative research process has been successfully compressed. It is now a simple, verifiable 4-step workflow for the individual investor.